This signal rarely forces action immediately. But when it does matter, it changes how fast the next phase arrives. And by the end of this video, you will know which assets feel it first. In our strategy, we track risk through a 5-phase cycle. We do not predict outcomes. We sequence probability as conditions evolve. This episode reviews a video by Joe Brown. He focuses on currency debasement and relative valuation. You should watch the original for full context. Markets look expensive. Cash feels unsafe. Most investors feel trapped between volatility and inflation. Expensive compared to what matters more than expensive alone. Most assets are priced in dollars. That framing changes everything. If the dollar loses purchasing power, prices rise in dollar terms. That does not automatically mean assets are overvalued. It means the unit of measure is weakening. This explains why many assets can rise together. But it does not remove drawdown risk. It only explains why capital keeps moving. This environment aligns with Phase 1 behavior, melt up with cracks, volatility without confirmation of a reset. Before this signal, Phase 2 risk sat in a moderate range. This framework nudges that probability higher. Not certain, but closer. Currency debasement supports asset prices. Liquidity stress creates sell-offs. Those are different forces. We care about when liquidity stalls. That is when correlations rise. That is when forced selling appears. If this signal persists, the most sensitive areas are SPY, TLT, ZRAs, gold, and oil. These are not buys. They are monitoring instruments. Stocks priced against gold are not at extremes. That lowers immediate bubble risk, but it does not remove volatility risk. This is not a buy window, but it is no longer distant. We are approaching ladder watch territory. Quick note, this is educational macro commentary, not financial advice. Exit discipline tightens. Volatility tolerance matters more. Optionality increases in value. We do not abandon structure. We do not chase returns. We do not predict timing. This next part matters for sequencing. Uncorrelated assets matter most late cycle. Rebalancing matters more than conviction. Liquidity expansion can extend this phase, but it also increases future instability risk. The risk is not being early. The risk is being unprepared when conditions flip. This signal supports continued participation, with tighter controls and higher sensitivity. Which signal do you think breaks first? Liquidity or credit? We do not need to be early, we just cannot afford to be late.